Hey everybody, delighted to be back with you. It's the Market Sniper, and we have John Lee, founder and CEO of the Silver Elephant. Haven't spoken in quite some time. Delighted to have you back, John. How are you keeping?
Fine, Francis. Good to be back. Thanks for the invite. Yeah, it's been a while.
It has indeed, and boy, has things moved since we last spoke as well. What's your take? Give us your take fundamentally. Gold, silver. Uh, it's been, I think it was a couple of years. We have certainly moved in a very positive manner. So, how would you build on that? What's your take?
Yeah, we had a hearty conversation about just under 2 years ago, I believe. And one of the things I remember talking to you was the the cup and handle formation with the neckline of gold at 2000, and that each succession, the intervals of gold hitting that neckline diminishes. So sure enough, early 2024, I went on a Twitter and said this is the best time to buy, and gold is going to take out 2,000 and with a minimum target of 2,400, and with a sort of an optimistic target of 2,800. And those levels, Francis, were based on the sort of the bottom of the cup, which is around 1,600. So on the linear scale, then you flip on the other side of 2,000 is be 2,400. But on the log scale, then you're looking at about 35% from the bottom to the neck, and then translate that from the neck to the top. Then we'll be looking at around 27 and $2,800 level. I think there's a 50% greater than 50% chance of us getting a 2,800, just based on the historical context. Every time there's a major breakout for gold, especially given the significance of this all-time sort of level being breached, that gold usually is gonna quite a bit. If you look at 2000 and 2005, gold went from 250 to over 500, and then from 2009, 2011 went from 800 to 1600. So if gold were to stop here at 2400 with a 20% registered gain, it's signal of a tame from just all aspects of it. Silver is being a bit of a laggard. I would have expected silver to take out 30 when gold broke out of 2000. And that's just on a very net neutral 70 to 1 gold to silver ratio. So silver has been a laggard until just a couple of weeks, till just a week ago. Part of the reason is, as I'm sort of looking backward and try to sort of put the pieces together, is much to do with China. I mean, China has been through what the United States gone through in the financial crisis, and Chinese equities were lower than the pandemic levels, and back to 10 level 10 not seen from 2015 and prior. And that has put a very heavy damper, I think, on the retail investment demand from China, as well as the industrial demand from China. But since then, the whole economy seems to be reflating, and the equities are rebounding. The base metal sectors are rallying across the board, like by copper, who's broken out to all-time high. And now it's sort of, I think now we're just a bit of a, it's either going to turn into it's either a obligatory retest to now the support level for gold, silver at 30 and for copper at just under 5, or it could be turning into something more sinister with the cooking up of the dollar and the weak seasonalities. Is yet to be seen. But I think the cards will be shown very shortly in the next couple of weeks on whether silver and base metal is going to resume their rally, or if this is a false breakout, of which we're going to experience a bit of a summer doldrum with rising interest rates. But under that scenario, then the equities also have to buckle, right? So I think the odds favor a sort of a vanilla retest for the metals to be embarking on a higher level, along with equities and rising sort of in the face of a rising interest rate. So I mean, I don't think it's a definitive call. There's always a glass half full, half empty. We just have to see what happens in the next few weeks.
Hmm. Yeah, there's so much to agree with in what you just said. You touched on copper as an industrial metal and how it's really come alive. That's been moving a lot. We've been highlighting that. And there was the subsequent and recent uncloaking of Druckenmiller, referring it to almost the one-way bet more recently, which were views you and I have had on the long side well before that. And now it's becoming more open knowledge. That's usually when it's about time for a little bit of a pullback as retail gets told about it. And that's been my reckoning. but generally significantly up, looking bullish. Silver turned and broke the 30, which has been a technical level. That's quite recently. It's been a really big technical level, the 30s. We had the Wall Street bets high, that was 21, along with the 20 high, that was gold's high. They were both quite tightly packed. And since then, it had leaned hard at level, and we'd been selling off on silver. So this seems to be a very clear breakout of, an almost 3-year pause, gestation, almost flag-like. And I see that going substantially further as well, like your good self. And I also see the gold, the next major levels being the doorstep to the 3K, just before the big doorstep to the 3K. So that's one level of ever escalating higher levels, because like you, we use log scale projections when we're dealing with the bigger time frames. And we've got a 6.5, we've got a 7.8, which many people will think, wow, that's kind of big numbers for gold. It just isn't the same world, and it isn't the same dollar. Right. And a lot will have happened in that time space, I imagine. And maybe you have a take, because what I liked about when we last spoke is that clearly you engaged yourself with mining and minerals, but you're very economically savvy as well in terms of the larger things. I'll drag you into the debt space. I found it very interesting, and maybe share your take. Comments that came out recently after the FOMC meeting. So this is quite recent, a couple of nights ago. The whole economic system has lost its sensitivity to interest rates, and we're going to need, the ability to cut, and we're going to have to keep higher and move more. And what we've actually seen is more and more the rest of the world coming to a position we've always had, is that the bond market, the debt markets turned in 2020. The 40-year bull market ended, and the rate cycle are now the things that will be in bull markets, and rates will continue to go more high than people imagine and for longer, and the pullbacks will be shallower and shorter. Everyone thinking every time it's a pivot. I mean, I sat having called the top of the bond market in 2020, being one of very few people that I knew that had positioned. I knew no one, in fact, but more and more people have come to our island in that space. And I listened to everyone, but the pivot, the pivot, the pivot. And the phrase pivot now seems to have been quietly shelved, much like the transitory inflation and many of the other narratives that seem to only serve for the short-termism and giving mood music to people, and also to lead them astray. The kind words that are lies to lead you astray versus the harsh reality words that I like to speak, that are very much a cold bucket of water and unwelcome, but happen to never go out of fashion to quite the same degree as these mood music phrases. What's your take on the debt market, having given you that preamble?
Francis, we just started a company called Oracle Commodity Holding. It's just got listed on the TSX in April, not even 2 months ago. We got about $6 million under management. And really, this is my passion. And we should be working together. I have an exact identical call and prognosis. You cannot, the ants are on the pot. If you just turn the temperature all the way to 100, they're gonna jump, right? You need to have the ants stay in. So you gotta dial the temperature up and down a little bit, but the trajectory is higher up. I also came on a couple of programs in March of 2022. I remember it was my birthday. I think it's 2022, I remember, or 2021. When 10-year was 1.5%. I said it's going to double to 3% by the end of that year. I think it's 2021 or 2022. And it went to 4.5%. I just came on a couple of programs yesterday and today. Is my highest conviction trade right now. We're a very, very heavy short 10-year. I think 10-year right now, it's the best. Both the fundamental and technical trades are aligned, and also the managers and cartels on our side wanted to push rates higher. This is an ideal trade in my sort of from my observation. And the 10-year right now is trading at 109, just below the 200-day resistance. We entered into what we shorted in the 109.5, and the 10-year yield is at 4.3, 4.4, and that is also at a 200-day support. What's interesting is if you look at right now, we're still looking at inverted yield curve, which doesn't make sense. On an inflationary environment, you should be at 10-year a lot higher. And historically, on an inflationary overheated environment, and you should be looking at 10-year at about 3% higher than the 2-year. But now the 10-year is still negative from the 2-year. There's been only 3-4 occasions where the yield curves is inverted, and every time this happened because the Fed were too aggressive in fighting for a heated economy, and then subsequently, so they raised higher than the loan rates. But it's always resorted back to a recession in which the short rates decline, and then to reestablish a normalcy. This time round, Francis, I go on your show, and that's what I want to talk to you about today. I'm glad you segue into that. Is you're going to see Fed funds rate at easily eclipse the 5%, close to 6% level by sometime end of next year. And you're going to see a major reversal of the 10-year from 4.5% to be trading at a premium in the yield higher than the 2-year. So you could be looking at 10-year close to 7 or 8% in the next, I would just say 24 months. This is a low medium term trade, and you could be looking at a 30-year mortgage approaching double digit. This is a 40-year secular bull market of the Treasury coming to an end, and it bears very significant resistance. The only difference between shorting Treasury and loaning metals is metals, you have the manager, the cartels working against you, right? So they have a limited war chest. So you're fighting volatilities. You're just fighting a bit of a heartache. You gotta be able to stomach some of the volatilities. But the yield trade, like you said, there's going to be noise. That's the purpose of having all the Fed governors coming in different days of different takes, and the minutes, and the minutes are different from week to week. However, right now, it's just right. I think the Bloomberg economists or the bankers are still pricing in at least another cut this year. I think they're going to be sorely disappointed, and it just tells me that the market is still hugely asleep with the major titanic shift of the landscape to be still sitting on 4.5-year 10-year. 4.5% 10-year doesn't make sense at all. You're going to see just an awakening, and you're going to see the 10-year zoom right past 6%. As right now, like the 10-year is on the cusp of taking out 5% any day now. I think the market perception is also slowly changing, and there's some relief of the Fed are not talking rate hikes, and soon enough you're gonna hear the Fed's gonna hike 25 basis and say it's good for now. And like I said, it's gonna slowly turn the dial on the temperature. I want to step back for a bit about copper. I'm a little bit dubious on this breakout, because even on the silver breakout, it was on a very quiet Friday, and it's a sneak attack on by the bulls. If copper were to staging a breakout and a reflation of the economy, oil should not be trading at below 200-day at 77. So this could be the copper trade, and also to some extent the silver trade, could be a more speculative trade from Asia or elsewhere in anticipation of the stimulus from China and elsewhere. So I am not still 100% quite convinced yet, especially if the dollar were to spike and with the summer coming in. So so I was probably 60% chance copper and silver stage a rally from here, having retested what's now the support. But you still have a 20-30% chance of just market turning sideways, metal turning sideways with this summer and with this rallying dollar. And there's a slight chance of these metals going back to testing below a staging as a fake breakout, of which silver could go back to the 20s and copper could go back to the mid $4 range.
You mentioned summer doldrums, and I quite like that phrase, and I think that still has a reasonable possibility of coming about. Let me respond to you a little bit, because you brought in some amazing stuff. First of all, I put up that 30-year Treasury total return, that just regarding our story on debt. That's kind of an inflection point around about the beginning of the 80s. That was gold. That was peak gold, and there's quite a key point to this. This was sort of 81, where peak gold, and of course the Nixon window following the Vietnam War that started here. and the over expenditure that went into that, never mind the moral issues, we'll just talk about it at an economic level, and the proliferation, the French calling for their gold and wanting the dollars back. Essentially, that was the run on the dollar before
It's the
going
same
free
today.
float.
It's the same
And it
today.
is. That's why I like this, because I mention it, and this is the 40-year kind of cycle. So from the free float era, they actually killed temporarily precious metals, and they got free float, and they got manipulation, everything. And isn't it ironic that the bond bull market, if you look for the key inflection point, for me, I think if I'm being the market sniper I fancy myself to be, I am putting my sniper sights right there and saying that there is the beginning of the expansion. And of course, it coincided with the demonetization of precious metals and the financialization of everything on a basis of free float and credit expansionism and a debt bull market. Because essentially, if you go from here, this is when you've just literally done this. And then, of course, the point of the chart is highlighting that you've actually lost 45%. This particular diagram doesn't show it, but you've lost 45%, nearly half from the highs
In just a year.
in literally very short time spell. I think the peak is 2020, so it's possibly 3 years into the beginning of 24. But the other point that you didn't reference, but that I like to bolt on to people that have like-minded view, what took 40 years to inflate isn't going to take 40 years to deflate. Escalator up, elevator down. And you've just had your first example of the elevator plummet, where this is a building parabola, you know, with in a percentage term, it's got that sort of rounding parabola where each one in percentage terms is going a little bit higher. This is a very abrupt and a rude awakening to the downside. And what most people don't seem to get is that for rates to go down, people have to want to buy treasuries to the extent that they are climbing the ladder up to bid to buy. In other words, they're gagging for it. And now you have a government that has never proliferated so much at such a rate and has never found more perverse new reasons, like funding the war in Ukraine, sending Israel on top of an already the largest nation recipient of foreign aid, all forms of special foreign aid for military reasons, very dubious ones, and every other dark state, military industrial complex, insider boys, dirty deals, harvesting. This feels like the end of the Grand Hotel, where the staff are unpaid and are peeling the valuables off the wall.
Yeah.
And it is a stripping almost for in lieu of the financial end of the the controlled demolition. And literally the final thieves, the smaller thieves, are even getting in on the act, stripping the grand old lady of its assets before it's left a burnt shell. That is how I feel about the current fiat and debt system. And to return to where you once were when the inflection went wild and gold was king, actually on this chart is a level for bonds so low it probably represents a 95% decimation from the highs of 2020. In terms of its distance above zero, it is almost negligible. And that, for me, is the round trip of debt. And so I am the ultimate bear on debt. But of course, they don't want to let it happen. They are balancing the balls in that sense so well. They don't want to let it happen in the same way as keeping precious metals control. When we had your high yield junk debt was supposed to capitulate, and we were short. We had lots of puts on it in the previous crisis, March 2020. And then the Fed showed up and said they were going to stand good. The ETFs of HYG, which happened to be the one I was short, and junk, JNK. So they literally held up the ropiest part of the debt market because the contagion of allowing it to start fraying at the edges and pulling out would have seen the entire, it would have been the equivalent of letting Lehman's go and not watching the rest of the banks go during the rest of them. So it's unbelievable
Yeah.
where we stand. But truth has to out. How do you see it playing out?
I see it a little bit differently. I would not use the word inflate and deflate. It's not really deflating. And secondly, I probably use 10-year better than 30-year because, as you know, 30-year it's been sterilized. Government hasn't been issued 30-year for a while. The conclusion is the same, but I see things a little bit differently, and that's really through a deductive reasoning and critical thinking and conjuring up. Whether the story, what you believe is true or not, eventually, is whether whether the market is aligning right with your thoughts or not. So I would not use the word inflating and deflating. And the way I look at it is, this is by design. So what we have is a engineered debt binge to create the demand for the fiats. And then the subsequent calling the fiat home to roost. So in order to achieve the 2030 agenda of own nothing and be happy. So you absolutely have to create the maximum demand for fiat, and which was achieved in 2019, 2018, where you have bonds that are trading at a premium, which means it's pure speculation, right? Because if you wait to maturity, you lose 20 cents on the dollar. And so you had you get the guys absolutely, it's almost like opioids. You apply maximum dosage to get the guys hooked on, and then you pull the rug under them. And so it's, however, you cannot be doing you have to keep the patient alive. You cannot just kill the entire world population because the world going to revolt, and then they're going to find the people to blame. So you have to keep them. So they're leaning off the dosage right now, but the eventual outcome that is to be desired and is engineered is a despair, is slavery, and so the timing and the instruments and the events were, I believe, all engineered, and they are literally asking people not to buy. Like they want to get people out of, like they want the debt market to collapse. So any support is only as a last resort. I mean, the managers cannot, even if they have 8 octopus, right? They cannot managing all the little details. So they're not controlling on weekly CPIs or unemployment or a bank will fail or not. It's too much micromanaging, but they just want to make sure the direction is steered in the direction they want, which is taking liquidity out of the market and through the purchasing, I mean, and have the interest go a lot higher. For instance, it's one of the very few trades where the power that be aligned, right, with the fundamentals, and the fundamentals of fiat is they're not worth anything, and the interest is to go a lot higher to entice the public to be staying in the game. But right now, what we have is that the market is so oblivious. They're still bidding up 10-year to have the yield lower than the 2-year. I think before you know, eventually you're going to have the 10-year yield trading at least 200, 300 basis points higher than the 2-year, which is going to be staying at above 5% from here, before 2030 is over. And at the time when you say, hey, when is the time to get out of the precious metals market, it'll be much like the 1980 scenario when the world is going crazy, when the yields are going double digits, and so, like I said, it's a lot mirroring today of what was happening in the 1980s. I was a child, I don't know what, but my father was telling me they had to pay 20% to buy their first home when I was 5 years old, and I was born in '74.
Yeah.
I just mentioned a thing about the market prices. Every time I say, you say, oh, this time is different, right? How is gold this time different from being put back under the lid? If you look at the news just came out, Russia is confiscating all of the U.S. assets that's sitting in Russia, including equities of Yukos, of Gazprom, of all the U.S. assets. Well, it's long overdue because $300 billion of Russian money is being sitting in the SWIFT, of which they couldn't get out. and China right now is slapped on the 200% EV tariffs, and then China is not buying AMDs and Intels anymore. You're seeing that division getting wider and wider. So you're only seeing the start of it. It's not like people are catching up, right? Like putting it, like, okay, the show is over, right? Let's go back to the ultimate agenda of the elites banding together to screw the little peasants. Right now, there's a war going on, and then also with the advent of digital currency, of which the euro is already published, the ECB has already published a white paper, and euros is imminent, inevitable. The digital euro is coming to fruition in the next 18 months, and the guys are, the billionaires like the founder of Zera and these elites. Some of them don't want to play this game, and they don't want to be micromanaged on where they can go, what they can buy, what they can eat, when can they shop, and the only way for them is to buy physicals. And just the way in observing how gold was acting in defiance of a rising dollar from 1900 to 2300. This is not like what we had before, where there's some sort of a climatic event of traders sort of bidding up the metals. This felt a lot more different. Now we got a temporary breather, and 50-day moving average is about 2320. We briefly touched that level. I'm not sure it's going to go down to 200-day of just over 2,000, 2070. It's also always possible in the summertime. But if that were to happen, it will present a wonderful opportunity for those who hasn't established a position yet. So right now we're not full throttle on silver. We got out of gold, and right now we're just very heavy into treasury short, because that is highest confidence level trade that can sit down there long term. It's going to roll over for the next 12 months until the 10-year trades at the premium to 2-year, and then we'll see if the landscape is at that time.
Yes, you mentioned yield curve inversion, and we've introduced that a lot to a lot of people who are unfamiliar with the concept on YouTube, and many others that are. And this is the longest inversion of the modern era, so the pre-79. Yeah. So I often say the bigger the dip, the bigger the bounce, the shock on the other way, the overreaction, because there's a natural geometry to dipping deep and low. The snapback is harsh. When do you expect it to happen? And what do you think will be the immediate outcomes of it happening when it reverts? Because as we often make the point, the reversion is the problem. The crisis typically starts to become known at that point.
You're right. There's about 3 or 4 different occasions. There's the 1995. There's a 1995 to 2000. I think there's one in 2007. It's always when the Fed hike up the rates too fast to try to tame the heating economies, and then subsequently with the correction, the Fed then do a 180 and start cutting rates. The market is still expecting that, the inflation being temporary. So the market is still betting on the Fed to cut interest rates while the 10-year normalizes at about 4.5%. The inflection point, I think, is going to come very, very soon, because the breakout happened, and almost 2 years ago, 18 months ago, for 10-year to be trading at 5%, and now it's just consolidating at the 4% level. And soon as the first rate hike by the Fed, which might happen this year, or if not early next year, right after the election, but the 2 years already trading close to the 5% breakout level again. So it's already tipping your hands in that the Fed is likely to be hiking rates but not cutting. So I think it's going to be first led by the 2-year breaking out of 5%, which could be imminent this year, followed by the Fed hike that interest rate. That would be, I think, the epiphany moment that the 10-year Treasury holders say, hey, wait a second, right? The narrative this time it's not like 3 or 4 times has happened since 1980. And that's why this yield curve is still inverted for so long, more than a year and a half now, whereas previous times it's only less than 12 months, is that people are still waiting for the rate cuts. It's still not happening. So people are still very, they're just being stuck up in thinking the past, which is not true. However, though, I am not sure when you say that, if the 10-year if the 10-year were to yield with the breakout, and then all the shit's gonna hit the fence, right? I'm not necessarily buying into that theory, because things are very, very bad. We know just anecdotally in my traveling, right? Things are not the same, even though the equities are hitting all-time high. And I think I briefly touched on that. I think you showed me the Kospi and whatnot. I say, hey, be careful in getting these bear tracks. And sure enough, right, we have all major indices, especially like the Taiwanese index, they're all establishing all-time high. My view on that is you have some players that are playing not by the rule, not by the books, which means that they are literally have the printing press. They own 70-80% of the S&P and all the major. They're not playing by the rules. It's the currency has their face printed on it. They do as they please. It's like I'm king of the castle. It's my currency. You know, it's not like if I need money, I need to apply to the bank and fill in my applications and filling my qualifications. Plunge protection team. It's all just pretense for the Vanguards and the State Streets and the Vanguard States and BlackRocks. I think they collectively, along with other offshore vehicles, a handful of guys probably control 70 up to 80%, maybe even more of the S&P. And higher rates are not going to deter them from their continued program buying. That is the only conclusion I can come up with. Because every time I short, I lose money. It doesn't make sense to have a war between the world's future largest economies, with a war going on in Ukraine, with Russia, with BRICS, with all this frictions, and you have markets breaking an all-time high. And with risk-free rate doubled, and yet the dividend yields hasn't increased. None of it makes sense other than that there are some people that are not playing by the rules, have limited access to liquidity, and they're just accumulating the equities and markets. And also the other anecdotal evidence is the advent of cryptos. The people that I hire from Gen Z, from millennials, from baby boomers, none of them invest in the S&P 500, but they're all talking about cryptos. So I think just the vehicle to distract, of the ordinary people from buying the equity market, because they need to own the Microsoft, the Googles, the Apples, Facebook in order to continue their surveillance, right? And provide that several major strategic towers of control to continue to influence the public to sway their opinions and lead the paths of which the power that be want them to be led.
Yep, I think there's very little to argue with that summary. And the thing with the other part is for explaining how things go up when it feels so bad. Markets go up, they climb wall of worry, all their usual story. But the retail consumer is squeezed. I have what I call the two balloon half theory, where you have the clown that's making an animal for your kid with a balloon. Right. And he's done the first twist, dividing the balloon in two halves, where the air represents the energy and the flow of money. And what's actually happened is they initially were 50-50, but what the air in the one is seeping into the other, and all new air is going into the one half, which is statist. We're already in a very communistic surveillance society. People that say, oh, one day they're trying to get a new world order, and you're already in that. Yes. In the sense that the state is the biggest spender now in most instances, and the biggest purveyor of contracts, and that is going to statist, corporate, fascist, surveillance, finance type corporations, such as the ones you described. Microsoft, Amazon, the military-industrial complex are contracting them to house the defense servers, the CIA servers, the FBI.
These are the tentacles. These are the tentacles of their reach. One thing you said though, not only do they control the printing press of which they can print whatever they want, whenever they want to buy whatever they want, they're still not happy enough that they want to debase your currency. They want to debase this voucher system. I look at it as a voucher system. Their wealth is not measured in dollars. So now you've accumulated so much paper in the last 40 years of expansion, like you said there, right? So some smart people were able to accumulate their wealth in these papers. Now they want to debase that money deliberately to try, so that they're just not playing by the rules. They want to change the rules of the game. Now, even if you survive through this expansion and come out ahead, they still want to screw you by debasing that money and by just.
Well, the two go hand in hand, you see. To drive the value up of the assets that they've bought, they debase the money. but to drive down the debt that they utilized at a very low cost rate as a insider value down, they debase the money. So the debasement of money serves them on both sides. They got cheap access to credit to buy corporately, many of them through corporations and assets like that. So it's not just about, oh, we'll flush out the final people with it. That's almost like a side effect bonus for them. They're actually killing the debt that they borrowed to own the asset. It's being devalued chronically, and the asset price valuation is climbing. That's why equities are going up, not because it's a great economy, but because the basis by which you're measuring everything is going so chronically down. You have to hold something that has an earnings stream, because at least, even though the monkey money, and that's my chosen phrase, the monkey money that they pay you in and they are utilizing is being debased. At least if you get an equity, the pricing will build that in, because your cup of coffee will still go up, because the inputs will go up, everything will go up, and therefore the return, still being a normal return, will go up with it, and thereby you retain buying power out of that income stream. So it's almost, as you say, it's debasement all around, except on the things that they've purchased. So it's really the big solving the great puzzle can be distilled down to asset allocation. You either in a monkey money, exactly,
virtual,
or you in physical things.
Tangible versus real. That's all it boils down to, right?
Yeah.
You know, for instance, I would go even one step further when you say they have access to cheap debts to purchase assets. I would go even one step further and say that the debt is an illusion. The debt is just a storytelling to enroll the public into playing this game. And what I mean by that is the ultimate guys are not playing by the rules. Like the debts, like they're just printing whatever number that they want from the Fed. Like the Fed, as I looked up, they're not private according to the definition, according to Encyclopedia, and they're reported to the governors, which is appointed by the president, which is non-compos mentis, who is senile. So who is controlling the printing press? This is oblivious, but the trend has been following since 1913 by design. The banks are their reach to garner assets because they can control the banks easily. But now with the advent of digital currency, they don't even need the SWIFT system and the Wells Fargos and then the intermediary banks and the credit union banks. They don't need any of that anymore, because with the advent of digital currency, right? They don't need these intermediaries anymore. So they can actually dispense. They say, oh, my God, banking prices coming, UBS is falling down, Deutsche Bank, there's going to be a apocalypse. And said, no, these banks, all they own is fiat. These banks could be all done away with, because eventually all you have is these banks are just intermediary intermediate vehicles by the power that be to manage, the illusory monetary system. Because when it comes to the end, the guys that print are not playing by the rules. Whether you want to create the ledger of asset versus liability, IOU versus not, eventually it's a cop-out system. They are, at this point in time, nobody's talking about deficit anymore, right? There's no talk of deficits. There's no talk about balancing this and balancing that. So everybody's to be a cop-out, and the guys are just printing to buy real assets. And that's S&P 500 included. That's why you also see very wide divide between the performance of Russell versus S&P, because they're not going to be bothered with the Russells, right, with the mom and pops, and they're centralizing all the industries into these major companies, which effectively has become state-owned, just like China, state-owned enterprises, because all the policies, the data, the directions, the evolve and the development is all dictated by the Fed. And if you say no, BlackRock, right, is going to call in Tim Cook and show him the share registry. And that's all that there is. It's really unfortunate that real assets are being exchanged for fiat that's being printed at will by a very select few people. Unfortunately, we're just being so oblivious. All the asset managers in their 40s, they're born, they're so oblivious. And people are still hoarding to buy 10-year, right? and at 4%. I think it's one of the best trade, Francis, you and I sitting here, of the next decade. This
We've
is
been the
exactly
ETF.
where we're at. Look, we missed the trade in 1980. Think of us as like we missed the trade in 1980 to buy Treasury. Like, okay, so maybe we missed the trade in shorting Treasury 2021 at 1%, but we are
No, it
still
didn't.
first inning. We're the first inning, second inning in a Treasury bear market. This is a fantastic trade that we're witnessing real time right now.
Yeah. Short debt is our favorite. You know, our short debt has been our favorite, and we took the long-term ETF. I'm trying to think of its name again, and we shorted that right from very high. We shorted in July 2020, August 2020. That was after the volatility it had and the super blow-off strength it had, and
Right.
that was a top call, and it was our first top call on debt, and it was in the same year that it turned, and it's a lifetime. It's a rainmaker trade.
Yes.
You know, it truly is a
And now
rainmaker trade.
the deal had a 2-year consolidation, almost 2 year, right? It's ready to break out again.
Yeah.
But I'm glad to be talking to somebody who's passionate about bonds as I am. Everybody's rolling their eyes over when we talk about it.
Yeah, as passionately out of love with them. I would say, given your profile, tell people, and I mean, I hope this isn't an annoying or a cliche question, but if we are going to be, for the Westerners, the average Westerners, and I keep warning them, you need to leave your country, and everyone says they want to make a stand and fight and defend their country, and I say, well, unfortunately, you've allowed the parasites to rule the head. So you can stand too at a local level. These guys are going to put into place the destruction mechanisms. And Biden's action against Russia is a destruction mechanism because it obviously invites a tit for tat. It's obviously going to see American assets lost or forfeited.
They don't care, and they don't care.
And they don't care, but it's going to be inflicted on corporations, and it's going to continue the bifurcation, which means you're picking a fight with the workshop of the world that you helped create, which is China.
That's okay. And they're higher inflation, which is exactly what they want.
Exactly. That's why I say, why would you want to do that? Well, because China will slap tariffs, they get more expensive. Trump will slap tariffs on China, that makes everything more expensive. Who pays? You do. Your Walmart items all just suddenly at their lowest cost, the super scaled economy business that has the scale of everything suddenly doesn't deliver cheap goods anymore because you're trying to source from other places. I've had a little bit of a to and fro with the guys that have been very proud about the dollar strength. So there's a sort of American nationalism, a little bit of the dollar milkshake guys, but they tend to, while their theory says gold wins in the end, they don't talk like gold bugs. They talk like dollar bugs. And whilst their theory says, it's a terrible place and America hasn't been good, they talk about, they compare American data releases and they say how fraudulent China's is. Not to say China's is great, but if they only knew how fraudulent their own stuff was, truly, they maybe wouldn't be so proud. So we get this kind of American nationalism. I think you're up in Canada, and I know we are both Westerners. I'm not dying to have the Chinese communists be masters of the world in any level or degree. But what should we be warning those that have a sort of, and I love the everyday American citizens. I'm talking very much about a certain financial Twitter group maybe, and obviously the people that are very pro their governments that don't see the exorbitant privilege and its mismanagement of the Federal Reserve. Let's just leave it like that. The parasite within. What would your message be, and what is awaiting us when, if China has a much more marked role and America has a greatly reduced role in the global world for us?
I don't see it that way. First of all, the dollar is just a symbol of fiat. It's the de facto voucher system. It could very easily be euro or be the pound or be something else that's synthetic. And the reason the dollar is chosen because of its legacy history, which is no longer the case. So, and I'm a dollar bull from the dollar index perspective. because all the other currencies are already being subordinated. The guys that's behind the Fed is the same guys that's behind the BOJ and the ECB and the BOE and the BOC. They're all the same people. It's just not easier to control one currency than having to tell other people what to do.
And can I jump and say that being a dollar bull means we are the biggest bear on the debt, because it's a rates-driven bullishness on the dollar, which will be a rates-driven collapse in the debt, and they are the biggest issuer. So they have to keep that devaluation side of the seesaw down. So when you say dollar bull, you're also implying bearishness on the American debt, which also talks to at least you're consistent.
Yes, consistent from the bottom, from the analytical level. I'm just talking from the top level. If I'm the king of the castle, right? And I manage 6 different provinces, and because of their histories, ethnicities, have different local currencies, I want to have control one currency. So the only way to do that is to have all the other provincial currencies subordinated to the currency that I print. And the way you do that is by military strength, is by coercing and by conjuring things like the Preston II Accords. So that's the first point. Secondly, again, I want to bring up to the higher philosophical level, because this is a philosophical discussion at this point somewhat, is that the people, unfortunately, that's behind the US Fed and the US government, they're the same people that financed Lenin 100 years ago.
Mao.
They're the same people that financed Mao Zedong 80 years ago. So it's just taken them a little longer to take over the United States, which they are essentially done. And this is not about Democrats or Republicans. I mean, this has been long in the making since the founding of the United States 280 years ago. So, all the woke stuff which come out of nowhere, and the equality, gender. I mean, it's not like South Africa where you're right now. There are different races. It's a lot easier to play the cards, right? But in any case, I don't see it as the rise of China versus the demise or the sort of decay of United. I don't see it that way. And the reason Chinese and America is fighting is not because of some ideological differences of democracy versus communism. It's because the guys that are behind the U.S. and Europe controlling Europe and elsewhere, they are becoming a lot more emboldened because they got bored. They got bored of this hegemony. They want to start something like they did in the 1970s. They just got bored, simply. And then also the middle class has accumulated too much fiat and wealth. They are interfering with they see too many people when they go vacation in Venice, right? They just say, hey, you know what? Things need to be dialed down. We need to go back to, you need to own less and be more compliant. The problem was that Xi Jinping and Mao Zedong don't see eye to eye. So Xi Jinping is not from the same faction as Jiang Zemin and Mao Zedong and Deng Xiaoping, who were financed by the Khazarians, and they're not even Jewish, by the way, Francis. So these people, so Xi Jinping has some beef, just like Putin, with how the perceived country's asset, which is AKA their own assets, were pillaged. So they're bucking against the trend in refusing to give a stake of Yukos in Gazprom, in Sinopharm, in accessing the Chinese market, in also indoctrinating the Chinese and the Russian public with some of their craziness, sadistic teachings, and so Putin and Xi Jinping don't want to put up with it, and that to the demands of the guys that are behind the scenes, and that's why you're having this war right now. This is not about democracy or rights of China versus this. This is none of that. This is about very few a handful of people exerting global control, dominant global control, and you have a few fringe elements that don't want to play by the books. Same with the Brazil president, right? That just got arrested in courts, and now you got Zula coming. And funny enough too, it's interesting. Just to back up what I'm saying is, if you look at the global equity indices, and there is a gap, and there's a lot of discrepancies. The more closely aligned between these countries and the power that be, the guys behind the scene, namely the dollar and the euro system, the higher the equity indices are. So if you look at, say, Taiwan, right, which have to rely on the United States to protect them, and the TSMC, of which it's gone crazy because the cartels are accumulating. Or Brazil, like soon as, so once you enroll into the dollarized system or euroized system, all of a sudden their equities and real estate boom because that provided very easy access for the king, right, to accumulate more. And the guys that are bucking the trend, you can also see that Hong Kong, China, to some extent Korea, and they don't like the storyline. They're not. It's kind of like that movie, right? 100 or 300. The gorilla came, and then you either bow down symbolically and pay a token of toll, or you say no, right? So the Russians and the Chinese say no. I'm gonna throw my javelin and make a go at it. And there are some that are just paying a little more lip service, like the Koreans. And there are some which is outright defiant, right? So I think there's a lot of different. You can see that just through their equity market performance. I mean, sure enough, in a globalized world, if there's a reflation in the global economies, everybody should be leveling up at the same rate, more or less, right? But you're seeing this dichotomy of different market performance, and that's because that is that can be explained or described as the compliance levels that these countries have to the big boss that's behind the scene. That's on a very high level descriptive. That's guys my sort of investment thesis.
I think you're almost there. I just think even the Russian and the Chinese are controlled too, but they controlled to be adversarial. So they get their synthesis by having the thesis and the antithesis. But the role that Russia and China are playing are actually this almost the sensible role, while the West goes woke and loopy. So that's why everyone gets to say, well, we deserve to fail. We lost it in the end. And I think, unfortunately, the West does fail. But then we slump into the middle ground, which it's ironic, but you actually have an ex-communist state, Russia, a current communist state, China, actually representing, in some senses, more reason and less provocative behavior than the supposed original capitalist nation that is America and Europe. I think Europe's a reluctant partner in the antagonistic agenda that America seems to be driving. And I think that's where that Khazarian element has got, they dig us deepest and they're the tip of the spear. They drive the hardest there. You look at Newland now and saying how Ukraine should be hitting Russian cities deep in and all of this stuff. This is the lady that overthrew a legitimately in place president of Ukraine in 2014. With a rent-a-crowd. Yeah.
Francis, two things. I have to say, just because your enemy's enemy doesn't mean they're your friend, and I lived in Russia briefly in doing business and several visits there, and I lived in China. I'm from Taiwan, but I've done a lot of business in China. It's just you don't want to be in that system. So it's definitely I don't see it as a morality issue. That's the first. And secondly, I go back to the question you asked me, though. I just read it here. What would you do? You gotta diversify your assets out of the United States and Europe. In preparation of the Euro digital currency, we have a couple of shareholders been through audit where 30, 40 million euros of their money was confiscated at the bank, and they went through a cleansing audit to try to, and they lost some money in that process. These monies were legitimately earned through real estate. It's not like they had any ties into communist or money laundering. So I see this as a pre-step in cleansing the money, in taking away any perceived ill-gotten gains or any of their adversarial powers or any money that's hidden under the mattress to be prime the market to be the next step, which is the digital currency. When you get to that stage, you're really screwed. They're going to track your carbon. You'll not be able to travel more than 3 times a year, regardless how much money you own in your bank account, or eat cows, or buy V12 Ferraris, or more than 3 condos. It's just like your currency, your voucher system, your money become voucher. Think of when you go to the supermarket, coupons, right? This, I can only buy this, but not that, and only during these days, but not those days. This is already happening in Taiwan during the pandemic. They experimented with this voucher system. They were giving you money that looks just like the real money, except that it has an expiration date. And then also sometimes it will designate the places where you can buy things. So they are already implementing that psychology to the people. So the money looks almost the same, right? Except at the back of it, it's just like, you got to buy before March 31st because this is a promotional by the government to stimulate the economy post-pandemic. So this, be assured, for instance, this is happening. They're going to take your money, and once your money is converted, you're gonna struggle to buy gold from Kitco. You're gonna struggle to buy things you want to eat, and where you want to go, and where and when you want to do, and where you want to buy. You need to get out of it. And I am not a huge. I just sold some of my real estate holdings to invest in Oracle for the to go public. So I'm liquidating some of my equity holdings to deleverage. And I would say if you own your principal residence, this is not a doom and gloom. Still, real estate are assets, right? Like Bill Gates and Jeff Bezos own a lot of farms and buildings. So the real assets, real quality assets, are still going to go up in price. But if you have leverage and expecting the risk to go down and betting on that, you gotta reverse your course. So I sold a couple of estates in Bangkok recently. It seemed to be an uptick in the market from the Chinese money, but I am continuing to deleverage some of my estates in United States and also in Canada. It's just the interest is going up, the rules regulations are going up, and the capital gains tax is being hiked in Canada. And then there's rules about the foreigners cannot buy. You have to occupy principally in the residence for more than 6 months out of the year. Just more and more, these things are just like, who owns this place, right? And so I'm not a big fan of real estate, especially particularly sort of vanilla varieties in a highly levered market, for instance. Those are my nuggets of advice.
Tax extraction strategy.
Buy some precious metals also. Yep.
Yeah. Absolutely, precious metals. It's part of everyone, but it does seem the more rules, more regs, more crowding. The kettling, the riot police kettling, where they trap people in streets in a circle. This town square, and they close in, and that's how they hoard your behavior into certain spaces, and then they control you. Then everyone has to sit down. No one's allowed to pee. You're getting the financial equivalent of fiscal kettling.
30 years ago, when I was a student in London, they have this scam show on Oxford Street. Whereas, you have like a rabbit, like a cell phone and batteries and toys. Come in, right? So once you go in, they close the door. So they started it's exactly. They will try to. Your exits are being blocked one by one. You gotta. There will be a time when it's too late, but there's a plenty of telltale signs. And it's for the first time in 20 years, we started buying gold. When gold was right about 1800. I said, this is not about your bank balance or making money out of. This is a permanent trade. Like, you got to stash it away. With my silver, I last bought silver was 2005. I bought some 2015, around $18, and I'm starting buying silver physicals again. And this is not about making a trade. This is about just something happens and there's a mandate of any sort. There's even talk about Australia as in UK, right? The frequency of commercial flights started going, like, you could be stranded, and the reducing frequency of commercial flights. I mean, literally, they literally want to handicap you with this green cities, bike lanes, EVs. It's just all of this is part of the scheme. Like, even the United States now in New York, you cannot build commercial buildings with gas-fired heat system, right? Why? Because it's not easier to turn off the switch than to turn off the gas tab. There is very number of subtle movements and things you got to really be careful. Hopefully I'm wrong, but I'm not so doom and gloom though. There's always a party elsewhere. So, like you, right? I've real estate in Asia, in US, in Canada, in all different parts of the world. And there are places they're having a good time. And so, like I said, there are always going to be elements perceived as rogue to the power that be, of which you can do quite well there, and it's quite safe in many parts of the world. Eastern Europe, another example. I'm talking to friends in Croatia and in Serbia, and they're doing quite well.
Yeah. Excellent. Tell us, we will need to wind down, and I really enjoyed talking to you. We are very like-minded. I'd like to chat a little bit more with you about all the interesting things you're doing after the call. But your particular state of play with your very, very interesting silver elephant development, where's everything standing, and how can people follow your progress?
Yeah, first of all, follow my Twitter, John Lee Silver Elephant, where I do a lot of market analysis and calling some trades that we're undertaking. And I'm very much the same approach as you are in marrying fundamental and with technical, and then making some sense out of the sort of crazy world. So follow me on Twitter, first of all. Silver Elephant has been my baby for 15 years. My passion is investment, and the asset has come a long way and is producing silver, generating cash flow. And it's got 100 million ounces in the ground with over $50 million investment. And right now, the stock is trading at $20 million, doubled in the last couple of weeks in this dollar silver breakout. And but it's still very, very undervalued. And you can look at it as a call on silver, of which you're buying silver for 20 cents an ounce in the ground. Of course, there's risk of political risk, environmental risk, pricing risk, operational risk. But if you are a firm believer in higher silver prices to come, then this is an interesting trade to consider. And check us out at silverelef.com.
What is the ticker symbol for everyone? Is it Toronto listed?
Yes, it's listed on the Toronto Stock Exchange main board under ELEF, and under the OTC under SILEF. Shares at 50 cents. It's good liquidity now, trading 300,000 shares, half a million shares a day. So it does have a good liquidity. And I would say that this is even maybe a better entry point than say when silver was under 30, right? Even though it's doubled in price at 50 cents, it's still 80% from what it was 3 years ago when silver broke out from 18 to 30 in 2020.
Excellent. And you've already pulling the silver out from the ground, so it's a functioning mine. I think last time we spoke, you hadn't got that far.
Right. The project has the silver minerals starts from surface, and it goes 1 kilometer to underneath the ground. So there are some pockets of very high grade silver that were recently discovered. And the artisanal miners and the guys back in 1800, 1900, managed by the Spaniards, they were mining very high-grade underground silver veins. But we managed to find some pods, satellite pods of very high-grade silver. And what we're doing is we're trucking these silver to a plant about 150 kilometers from where we are. And we got for a total of up to $7 million US. They're literally just scooping up, this pods of looking like dirt off the ground and shipping to their factories for processing. And they're paying for all of our operating expenses, community relations, which is great because once royalties are being paid, people are being hired, you usually get less trouble from the government because everybody is the status quo, right? There's revenue coming in. So there are a lot fewer troublemakers. So right now we are self-sustaining. We've only diluted 2% of our equities in the last 9 months just to pay our director, settle some of the management debt, and the money from a company called India Mining is filling our daily expenses. By the early next year, Francis, early next year we will have a permit to build a plant at the site. So from there, then we can then process materials in-house. And then so that we can write much higher margin than we are now. Earlier, we just pay the bills, right? So certainly we're not getting that leverage on higher silver prices because the up to 7 million is fixed. But that's just a scrape of the surface. That's like 2% of our resource for the project. And so the crown jewel is yet to be exploited a little bit deeper from surface. So we're very excited about it, and I think the story is somewhat quite undiscovered, and we're just being so busy on getting Oracle commodity listed. That's a company we just listed. We took the Oracle symbol from Oracle US, it's ORCF, on the TSS Ventures, and so we're just busy getting some of the domestic affairs sorted out, and now we have, and that's why we're sort of putting ourselves out there, just make the story known and getting reacquainted with you and with a few other supporters and people that are close to us.
Excellent. John Lee of Silver Elephant, great to have you back on. Thank you so much for giving us an update on your progress and also for your takes on the debt markets, the precious metal markets, and everything else we chatted about today.
Such a pleasure. Hopefully, sometime we talk again the end of the year at $50 silver, $2,800 gold, and you're looking at 5% Feds and around 6%. Well, 6% will be too much of a stretch, but higher 10-year. And it'll be interesting to pick up that discussion at that time.
Indeed. Look forward to that.